Hello, everybody. This is Jamsi. I'm a finance professor, and for today's video, we're going to be tackling an overview to the financial markets. So our agenda for this chapter is to discuss the overview of the financial markets, the importance of the financial markets, the different types of financial markets, the types of financial institutions. We'll discuss more about what happens in an IPO and some of the stock market efficiency theories. So let's begin. In the financial markets, there are always players. And who are these players? So there are two sides of the coin. There are the providers of funds and there are the users of funds. So let's talk about the providers of funds. From the word itself, the providers of the funds are the suppliers of the capital. These are the savers, meaning the individuals and institutions with excess funds that look for a rate of return on their funds that is to be provided or invested to the users of funds. Now, when we talk about the users of funds, these people or businesses can be individual borrowers or corporations that need funds, meaning they are the ones demanding and they are the ones who would like to use the funds for capital. These are people and institutions who need funds to finance their investment activities. And these people are willing to pay a rate of return on the amount they borrow or receive from the suppliers of the funds or the providers of funds. Now that we know the players, let's see how the money flows in the financial markets. So I believe there are three ways in which capital is transferred between the savers and the borrowers. So let's take a look at the example. First up, we have the direct transfer. So from the term itself, the providers of funds will give the money directly to the users of funds for the latter's securities, meaning in exchange for shares of stocks and long-term debt like bonds, without going to or without the intervention of a third-party organization such as a bank. So how does that look like? It looks like this. So when we're looking at a direct transfer, it is a direct transaction between two individuals, two businesses, or either of two. So the users will give shares and dividends or bonds and interest to the providers of the funds in exchange for the money that they need to fund their investment activities. So what could be the problems that could be encountered in a direct transfer? So first up, it's costly on the part of the users of the funds. Because, what's the problem here? Because the providers of the funds can easily control the amount of return that they would like for the fund. Meaning, this is a personal transaction between two individuals or two businesses. You don't have to go through a third-party intermediary That is why the rules can be set and can be different on a case-to-case basis. Now, what does this mean? In some cases, the providers of the funds can ask for a higher interest rate than if the user goes to a bank, applies for a loan, and gets a loan approved at a much lower rate. Now, that is the problem on the part of the users of funds. Second, it's risky on the part of the providers of the funds, meaning it's risky for those who are the creditors in this particular scenario. So, what does this mean? This means that since there is no third-party intermediary, there is a risk that the borrower could be a flight risk to the providers of the funds. And since there is no third party in the middle that is making all the necessary negotiations, making all the necessary checks, then it is risky on the part of the provider. Paano if hindi ako mabayaran ng pinautang ko? And third, it's difficult to match the need of the users of funds. So sometimes, if you go directly to a creditor as a borrower, sometimes you will say, hey, pahiram ako ng 10 million. And the borrower will expect 10 million. But the provider can only provide probably 3, 5, or 7 million because wala siyang ganun kalaking pera. So if you go this route, then it's highly probable that you will have to go to another creditor to complete the amount needed for your business or your investment activities. All right? So this is the direct transfer. All right? Now, if you would look at the chart, we see here that the providers of funds earn the rate of return through dividends, interest, and eventually if they have to sell the shares, they will have to earn it back through the market price. So in this case, the returns of the providers of funds will depend on the earning capacity, the market price of the share, and of course, their own expectations because they're the ones who are setting the acceptable rate of return. All right? So I hope that's clear. Second, we go to investment banks. Investment banks facilitate the issuance or selling of a corporation's securities. For example, the selling of shares of stocks and bonds. So the investment banks would buy securities from the corporation and sell them to the savers. Securities, meaning the financial instruments in the form of stocks and bonds. And of course, the payments will just pass through the investment banks. So let's take a look at how investment banks aid in the flow of capital within the financial market. So let's see. It's like this. So, providers of funds, those who have excess money, meaning private corporations, GOCCs, or individuals, will go to investment banks to find their fair share of investment opportunities. Of course, the investment banks will have a ready portfolio of bonds and shares of stocks to be sold to the providers of funds. Now, where does this portfolio come from? This portfolio will come from the users of funds, meaning those who need to raise capital. How do they raise capital? Of course, by selling rather shares and bonds. So on the other side of the coin, the users of funds will devise a bond offering and go to investment banks and ask for help in selling the bond offering or in selling their shares. Now, the investment banks will be the ones responsible for distributing these out to potential investors, also known as the providers of funds. Now, you will ask, how do investment banks earn money? If they are pass-through entities, of course, there are charges, there are fees charged by investment banks from any of these transactions. That's how they earn money. All right? So, investment banks act as the middleman in this case. So, investment banks will face the providers of funds and provide them with the stocks and the bonds. And the investment banks on the other side will also face the users of funds and provide them with the money they need. So essentially, in this transaction, there is no direct meeting between the users of funds and the providers of funds because it is through investment banks that these happen. So essentially, we're saying that to the users of funds, they only know that they sought the help of an investment bank and they are working with a particular investment bank. They will see a list of investors, but they could not meet them one by one. Of course, they will know the list because they would have to give out eventually dividends and interest to the buyers. But mainly, the giving out of dividends and interest will even be facilitated by the investment banks. All right. So that's what happens when an investment bank comes between the users and the providers of funds. Now, ano yung pangatlo? There's a third one. The third one being financial intermediaries. So, financial intermediaries will also obtain money from savers in exchange for their securities. But it will take another form. So how do these work? So these financial intermediaries offer products. So as an example, a commercial bank is a financial intermediary because they offer deposit accounts to individuals who would like to save money, or even insurance companies who will offer insurance policies, as well as mutual fund companies who offer mutual funds to individuals. So these financial intermediaries will pool these funds from the savers, then they would buy other corporations' securities, meaning stocks or even long-term debt, using the money that they obtained from the providers of funds. Thus, they create a new form of capital and convert one form of capital to another. And that's how, to be honest, that's how they make money. That's how these financial intermediaries are able to give individuals the interests and the returns on their insurance policies or their mutual funds. Now, how does that look like for us? Looks like this. So as you can see here, it's almost the same as the diagram on or with the investment banks on the other in the middle. But as you can see, there's a big difference. Why? Because the providers of funds will go to the different financial intermediaries to make their savings transactions, to buy their insurance policies, and to buy their mutual funds. That's it. The money that the financial intermediaries collect out of these individual transactions are being pulled and they go to the users of funds because they would like to purchase stocks and bonds. Now, at the end of the year or whenever the users of funds would declare dividends or would pay out interests, they would pay out the interest to the financial intermediaries. And these financial intermediaries will give out a portion of the dividends and the interests to the providers of funds as incentive for letting these financial intermediaries use the providers' funds to make money. That is honestly how banks, insurance companies, mutual funds, and other financial intermediaries work. Knowing that there are three ways to transfer capital from the providers to the users, why do we need to go to the financial intermediaries? Simple. Because number one, financial intermediaries hire highly qualified people to assess risky investments. For short, they're the experts. So they know better in terms of assessing the levels of risks in any investment decision. Second, the financial intermediaries are adept in diversifying money or funds to different investments instead of only putting it in a single investment. So here, you've always heard of the saying to never put your eggs in one basket. The financial intermediaries are good at this in such a way that they will help or they will be able to diversify the portfolio in such a way that they are able to minimize the risk of the investments. Para pag nalugi yung isang portion ng portfolio, there are still other viable portions of the portfolio that will be able to make up for the losses. Third, financial intermediaries have a cost advantage and economies of scale because they can immediately operate on a big scale because they don't have to search for individual providers of funds or search for individual users of funds. These people, whether you are a provider or you are a user of funds, are going to them. Nagde-deposit ka araw-araw. You buy insurance policies. People will take out loans on a daily basis. May magbubukas ng letters of credit. So that's a cost advantage to the financial intermediaries. Number 4, the financial intermediaries help reconcile conflicting interests of users and providers of funds. So because there is an intermediary in the middle, the users and the providers of the funds do not meet face-to-face. Therefore, the providers could not impose their own expectations on the users of funds. They cannot say, hey, I want 15% return outright. They would have to transact with a financial intermediary and agree to the terms that are stated in the contract. Naka-predetermine po yung rate of return that is going to be given by the financial intermediary to the users of funds or the providers of funds, I'm sorry. In the same manner, in terms of the users of funds, the users of funds cannot also impose kung ano yung gusto niya to the providers of funds. They cannot say, hey, I can only pay 3%. Bahala ka dyan. But they would have to talk to the bank, the mutual fund, or the insurance company and agree as to the rate that they are going to pay out in exchange for the additional funds that they are borrowing. Lastly, financial intermediaries give providers of funds liquidity. So, which means that anytime these providers need their money, they can easily take it out of the financial intermediaries' hands. So, they are providing or they are ensuring liquidity on the part of the providers of funds. In the next video, we are going to discuss what a market is and the different types of a market. Until then, see you on the next one. Bye!